I want you to imagine a scenario. It's the mid-1950s, you've got a little bit of savings, maybe $1,000.
Okay.
And you decide to bypass the big names, the GEs, the Coca-Colas, and you put that money into this small, kind of struggling media company.
A bit of a gamble.
A huge gamble. You tuck that stock certificate away and you just hold it. You hold it through the 60s, the 70s, the 80s, all the way to 1995. Any idea what that $1,000 would be worth?
It's a number that's it's almost hard to comprehend. We're talking about a 2,000 to 1 return.
2,000 to 1.
That $1,000 would have turned into roughly $2 million.
Wow.
To put that in perspective, that just crushes the S&P 500. It outperforms legendary hedge funds. It is, quite arguably, one of the greatest compounding records in the history of American business.
2,000 to 1.
Yeah.
That's a tech startup number, you know? Not something you expect from a traditional media company in the 20th century.
Exactly.
And the really wild part is the man behind this record isn't a household name. He's not Steve Jobs in a turtleneck or, you know, Elon Musk tweeting at all hours.
No, he's the ultimate quiet giant. His name was Thomas S. Murphy, CEO of Capital Cities, which eventually became Capital Cities ABC. And you're right, he flew under the radar by design.
But the people who know, they know.
Oh, they definitely know. I mean, Warren Buffett calls Murphy his mental partner. Buffett actually said Murphy is in the same tier as Bill Gates.
Okay, when the Oracle of Omaha puts you on the same shelf as Bill Gates, that's not just a compliment, that's a certification.
It absolutely is.
So our mission for this deep dive is pretty clear. We have to figure out how he did it. We've got a whole stack of sources, biographies, analyses of his partnership with Dan Burke, details on that massive Disney acquisition, and even Buffett's own letters.
Right. We're going to deconstruct the Capital Cities playbook.
And it really is a playbook, isn't it?
It is. This isn't just a biography. It's a masterclass
Yeah.
in rational capital allocation. We're talking extreme decentralization, a roll-up strategy, and this fascinating idea that a nice guy, because by all accounts he was a true gentleman, can finish first by just being the most disciplined operator in the room.
So let's start at the beginning, because his path wasn't exactly a straight shot to the C-suite.
Not at all. He wasn't born into a media dynasty. He was a Brooklyn native, born in 1925. His early career path was incredibly nonlinear.
What was he doing?
Well, he served in the Navy during World War II, came back, went to Cornell, got a degree in mechanical engineering.
An engineer.
But, and this is a crucial detail, he didn't actually like engineering. He realized pretty quickly that sitting at a drafting table just wasn't his thing.
Joe, he's an engineer who doesn't want to be an engineer. That's a tough spot.
Right. So he pivots. He decides business is where it's at. He applies to Harvard Business School.
Yeah.
And they reject him.
I love that. The guy who generates a 2,000 to 1 return gets a rejection letter from Harvard. It gives the rest of us hope.
It really does. So instead of a classroom, he goes to the School of Hard Knocks. He takes a job as an industrial oil salesman for Texaco.
Wow.
And I think this period is really underrated in his story. He wasn't in some ivory tower. He was carrying the bag, you know, knocking on doors, facing rejection, trying to sell a commodity.
That builds a certain kind of grit, doesn't it? You learn how to read people.
Precisely. It grounded him. Years later, when he was a titan of industry and actually sitting on the board of Texaco, a great full-circle moment, he still had that salesman's humility.
So he eventually does get into Harvard.
He reapplies, gets in, and graduates as a Baker Scholar, top 5% of his class. But the real education, the thing that forged him, started in 1954.
This is the Albany Crucible.
Yes, a family friend, Frank Smith, recruits him to run a television station in Albany, New York, WROW-TV. Murphy is 29 years old. He has zero broadcasting experience.
And he walks into a disaster.
A complete disaster. The station was losing money. It was nearly bankrupt. But the technical problem was even worse.
What was that?
WROW was a UHF station. Now, for anyone who didn't grow up with the rabbit ears on their TV, you have to understand this. Back then, the big stations were VHF. Very high frequency.
Channels 2 through 13.
Right. Where NBC, CBS, ABC lived. The signal was strong. Every TV picked it up. Murphy had a UHF station.
Ultra high frequency. The high numbers on the dial.
The signal was weaker. It didn't travel as far. But the absolute killer was that standard TV sets didn't even have a tuner for it.
So to watch his station, you had to go out and buy a separate converter box.
You had to go buy a separate box. It was a marketing nightmare. You're competing against General Electric, who owned the big VHF station, and your pitch is, please go buy an expensive piece of hardware so you can watch our snowy, fuzzy picture.
That's brutal.
Murphy was terrified. He later said he thought he was going to bankrupt the company in his very first executive role, but that pressure cooker forged the entire Capital Cities philosophy.
How so?
He looked at the situation and realized, I can't compete on signal strength. I can't compete on money. We're broke. So what's the only lever I have left?
Hustle.
Yeah.
And costs.
Bustle and extreme cost control. He had to be the low-cost producer. He looked at every single line item. If a dollar didn't help sell an ad or keep the transmitter running, it was cut. No fluff, just survival.
And he turned it around.
It took 3 years, but he turned that near bankruptcy into a profitable business.
And that trauma, for lack of a better word, it seems like it stuck with him.
It never left him. Even when they were billionaires, he ran the company like he was still scared of going broke in Albany. And that leads us directly to the playbook.
The core philosophy.
Exactly. His core tenet was, hire the best people you can and leave them alone. Radical decentralization.
And this was totally against the grain at the time.
Completely. I mean, look at CBS or NBC back then. They were building these massive centralized bureaucracies in New York City, layers of vice presidents for everything.
The guy in New York telling the guy in Houston what to do.
Exactly. Murphy looked at that and just said, that's crazy.
I read a stat about their headquarters that I honestly thought was a typo, the 36 number.
Yes. Even after they bought ABC, a massive network with billions in revenue, the capital city's corporate headquarters had only 36 employees.
That's insane.
And that 36 included the secretaries and the receptionist. It's unheard of. Murphy believed the manager of a station in Fresno knew their market better than some suit in Manhattan. So he gave them total autonomy.
But with total autonomy, how do you keep everyone rowing in the same direction?
Accountability. That's the other side of the coin. He gave them freedom, but they were strictly accountable for the bottom line. Hit your numbers, you're left alone, and paid very well. Miss them, you've got a problem.
There's that famous story that illustrates his frugality, the painting the building story.
A classic.
Yeah.
So the station manager sends a proposal to Murphy. The station's looking shabby. He wants to repaint the whole thing.
He seems reasonable.
Murphy looks at the proposal, pulls out a pen, and approves the cost to paint the 2 sides of the building that face the road.
But not the back.
He crosses out the cost to paint the back 2 sides because nobody sees the back. The advertisers driving by only see the front and the side. Painting the back generates 0 return on investment.
It sounds cheap, but it's not. It's rational.
That's the word. He was being rational, not cheap. He viewed every dollar as an investment. Does this bring a return? No. Then we're not spending it.
It sends a powerful message to the whole company. We don't spend money on vanity.
He was known as the cab man, right?
Yes. While other media moguls were in limousines, Murphy was hailing yellow cabs. He had this great train analogy.
What was that?
He'd say, the goal is not to have the longest train. The goal is to arrive at the station first using the least fuel.
That is such a profound distinction. Corporate ego wants the longest train.
Of course it does. Look how big my office is. Murphy cared about speed and fuel efficiency, and to keep that engine running, he needed a partner.
Daniel B. Burke.
His operator. He hired Burke in 1961. Murphy was the architect, the deal maker. Burke was the operational disciplinarian. He was the one grinding down on the budgets. A bit of a good cop, bad cop.
A little bit, but they built this culture that people loved because it was a meritocracy. It was fair.
I heard about the bartender story.
Oh, that sums it up perfectly. There was a company retreat. Afterwards, the bartender working the event went out and bought stock in capital cities.
Why?
Someone asked him, and he said, I've worked a lot of corporate parties. This is the only one where I couldn't tell the bosses from the subordinates. No status seeking, no posturing.
And that lack of ego let them execute their growth strategy, the roll-up. Can you break down how he did that?
Sure. The basic idea of a roll-up is simple. You buy a company, you fix its operations to boost cash flow, then you use that cash to pay down the debt you took on to buy it. Then you repeat.
Buy, fix, pay down debt, repeat. The problem is most people get addicted to the buy part.
Exactly. They overpay, they take on too much debt. Murphy was incredibly disciplined, but he had a specific hurdle most people don't. The FCC.
Right. The government had strict ownership limits.
The rule of 7. You could only own 7 TV stations, so he had to play 3D chess. To buy a bigger, better station in a bigger market, he often had to sell a profitable one he already owned.
He was constantly trading up.
Constantly. And the 1971 Triangle Publications deal really highlights this discipline.
This was a big one.
Pivotal. He gets a chance to buy Walter Annenberg stations, including WPVI in Philadelphia. A massive market. A crown jewel asset that just prints money.
But to get it
And stay legal with the FCC, he had to sell the TV station in Albany.
his first station, the one he saved, his baby.
The very same. And this tells you everything. He viewed assets as fungible capital,
Fungible, meaning interchangeable.
meaning he had 0 emotional attachment. Most founders would say, I can't sell Albany, that's where we started. Murphy just looked at the spreadsheet. Philadelphia generates a higher return on capital. Sell Albany, buy Philadelphia. It's cold, rational logic.
He never let sentimentality get in the way of compounding.
Never. And they moved into newspapers, too. bought the Kansas City Star. And critics at the time were saying, oh no, these ruthless cost-cutters are going to ruin the journalism.
But they didn't.
The opposite. Under Cap Cities, the Kansas City Star won 3 Pulitzer Prizes. Murphy's argument was that financial discipline protects quality. A profitable newspaper can afford to do investigative journalism. A bankrupt one can't.
Okay, so they're growing, they're trading up. But then comes 1985, the main event.
The year the minnow swallowed the whale.
They acquired ABC.
For $3.5 billion.
Just to set the scene, how big was Capital Cities compared to ABC at that point?
Cap Cities was about 1/4 the size of ABC. It was audacious. The Wall Street Journal headline was literally, minnow swallows whale.
He was betting the entire company.
And to do it, he needed a massive amount of cash. And this is where Warren Buffett goes from being a fan to being a partner.
How much did he need?
He needed $517 million in equity. So he sets up a meeting with Buffett. Usually a deal this big takes weeks of due diligence, lawyers, accountants. They met for 15 minutes.
15 minutes for $500 million.
Buffett said yes. It was the largest investment he had ever made at the time. He wasn't betting on media. He was betting on Tom Murphy.
He was betting on the jockey, not the horse.
100%. He believed Murphy and Burke could manage those assets better than anyone else on earth.
So the deal closes. The Capital Cities guys walk into ABC headquarters in Manhattan. What's the first thing they see?
The definition of corporate bloat. A culture of pure excess. ABC had a lavish skyscraper headquarters, a private elevator only for executives, an executive dining room with white glove service. It was a royal court.
And here comes the cab man.
Here he comes. Murphy and Burke took one look around and just started swinging the axe. Sold the headquarters for $175 million, moved everyone to cheaper offices,
Gone.
shut down the executive dining room, ripped out the private elevator.
I imagine that was a massive culture shock for the ABC execs.
A revolution. They cut the staff by 1,500 people, which sounds harsh, and for those people it was difficult. But the business was suffocating under its own weight.
And what was the result?
By clearing out the bureaucracy, the operating margins at ABC jumped from the low 30s to over 50%.
Incredible. It validates that rowboat analogy that Buffett used.
Oh, totally. Buffett compared CBS to the Queen Elizabeth. 2 massive resources, but impossible to turn. He said Cap Cities was a rowboat, but the rowboat won because the guys in it were just rowing harder and smarter.
They weren't weighing the boot down with gold plating.
Exactly.
So we've talked cost-cutting and acquisitions.
Yeah.
But there's another pillar of his capital allocation that Murphy mastered. Stock buybacks.
He was a pioneer here, and it's important to explain why this matters.
Right. For anyone listening who isn't a CFO, why is buying your own stock a good idea?
Think of the company as a pizza with 8 slices. You own 1 slice. If the company takes its cash and buys back 2 slices from other people, the pizza now only has 6 slices.
But I still have my 1 slice.
You still have your slice, but your slice is now a much bigger percentage of the whole pie. You own more of the earnings without spending a dime.
It concentrates the value for the people who stay.
Exactly. Murphy would aggressively buy back stock whenever he felt it was undervalued. He joked that the employee stock purchase plan was an IQ test.
Meaning if you didn't buy it, you were failing the test.
The stock was such a clear bargain, yeah. You're failing the test.
I want to touch on the soft side of his management. We've painted a picture of a ruthless cost cutter. But Buffett always praises his emotional intelligence.
That's the paradox of Tom Murphy. He was ruthless with costs, but gentle with people. He had a strict rule about anger. He'd say, you can always tell someone to go to hell tomorrow.
Don't spout off in the moment.
Right, don't act in a moment of anger. Buffett still quotes that as one of the best pieces of advice he ever received.
And what about the feedback rule?
Praise by name, criticize by category. If John Smith does something great, you praise John Smith at the meeting. If the sales department misses a target, you criticize the sales department.
So you address the systemic failure without humiliating the individual.
And it built incredible loyalty. People worked hard for him because they respected him, not just because they were scared of him.
So let's go to the final act, 1995, the Disney sale.
The masterpiece. Murphy's at the Allen & Co. conference in Sun Valley. He bumps into Michael Eisner, the CEO of Disney. Buffett is there too. They start talking on a sidewalk.
Yeah.
And in 3 days, they hammer out a deal. Disney buys Capital Cities ABC for $19 billion.
$19 billion from a near-bankrupt UHF station in Albany.
It solidified his legacy as one of the outsiders, a term from William Thorndike's book. These were CEOs who ignored the institutional imperative, the need to just get bigger for ego's sake.
He didn't care about being the biggest.
He cared about per-share value. And that $19 billion check proved he was right.
So let's distill this. For the person listening, What are the big takeaways they can apply to their own business or career?
I think there are three core lessons. First, decentralization requires accountability. You can't just let people loose. They have to own the results.
Trust, but verify the numbers.
Second, frugality is a competitive advantage. It's the big one. If your costs are lower than your competitors, you have more options. You survive downturns. You can buy assets when everyone else is selling. Frugality buys you freedom.
And the third?
Rationality over emotion. Whether it was selling his first station or not painting the back of a building, Murphy removed his ego from the decision. He looked at the numbers, not the narrative.
And maybe there's a fourth lesson, just about the nature of the work itself.
Absolutely. When you read about Murphy, one thing stands out. He had fun. He enjoyed the game of business. He wasn't grinding himself into misery. He was energized by the puzzle.
He tap danced to work. It's a compelling blueprint. So here's the question for you to chew on. In your own organization or your own career, are you building a Queen Elizabeth II? Impressive to look at, lots of bells and whistles, but impossible to turn.
Or are you rowing the boat? Because as Tom Murphy proved, the rowboat usually wins. And remember, don't bother painting the back of the building.